Welcome to ECN Trade Daily Video. Before we begin, it should be noted that any advice is of a general nature only and that your personal circumstances have not been taken into consideration.
Hello everyone, my name is Rob Clayton and thank you for joining me. After experiencing a notable setback in its bullish trend, the Australian dollar experienced a modest bounce on Thursday, clawing back much of its slide that we saw on the previous day, which was triggered by Wednesday's much hotter than expected Consumer Price Index, or the CPI reading, which sent investors to the exit door. However, traders breathed a sigh of relief as the Producer Price Index, the PPI data, showed a modest climb of 0.2%, falling short of its expectations of 0.3%. This contrasts with the 0.6% growth observed in February. However, it's still uncertain whether the cooler inflation report, meaning the PPI, from March's heated Consumer Price Index report. Following the update this week from the inflation data, fewer predictions point to multiple rate cuts by the Federal Reserve this year compared to earlier forecasts in 2024, which hinted at least 6 or more rate cuts. Presently, the market is now adjusting its expectations for a rate cut, possibly moving it from June to either July or September's meeting. In other news, a separate report showed fewer US workers applied for unemployment benefit last week after it decreased to 211,000 from 222,000 from the previous week. So while respecting the level of 64.8090, we can see the market is now back focusing on the 60-day moving average, which is seen roughly around the area of 65.5. A break above there should give further scope and possibly put the market back on track to its previous prediction of 66 to 67 cents. The euro found further weakness on Thursday, even though the tamer US PPI data failed to shake off the bearish sentiment. And along with that, as widely expected, the European Central Bank, or the ECB, maintained rates unchanged. Although Christina Lagarde highlighted the fragile economy, expecting inflation near target levels but next year, but noting downside growth risks still remain. She emphasises the ECB's independence from the Fed and hinted at a potential action before inflation hits the 2% target. With the key level seen at 107.1015, keep an eye there because we could see stops beneath there and therefore see a fall towards 105.80 before the broader aspect kicks back in and retraces back towards 109 to 110. Once again, the Japanese yen weakened and reclaims the 153 target, and still presently no show from the Bank of Japan as potential intervention round the 1990 highs still overall expects a weaker play. Given the fact that I've adopted to a neutral bias due to the high risk potential above 153, I'm now observing the level of 152.4060, which if triggered should see a further slide towards 150.5, and from there further assessment should be conducted in case we see a further weaker play. Nevertheless, at these levels I'd rather sit out and see how we progress into today and see where the New York closes at the end of the week. Sterling also respecting its key level of 124.8090, and while intact, I do anticipate a recovery back to the top side anywhere from 127 to 128. The technicals are a little bit weak and clearly bullish divergence as prices record lower lows and the indicator remains from a low to a high. Then we could see demand returning and see the market elevate back to its broader call. Spot gold surges and resets its highs, and I still remain negative as we are still in uncharted territory. Nevertheless, I clearly view that from the bearish divergence with an indicator dropping down in terms of the decline and the price increasing, I feel there is a significant downturn. So therefore, trading this commodity, I still give much warning that increased volatility will emerge. So traders should reassess crucial levels and adjust strategies according to their risk management. But like I say, a neutral bias persists as no clear upside view is evident as we do explore uncharted waters. But I still keep an eye on this divergence, and if so, could see a significant downturn, bringing it somewhere around the lows of 2,300. Wrapping up with oil, little has been seen in terms of direction, but the technicals are still heavy, so I'm still holding the call that the market can potentially move towards $83 a barrel, or even lower to 81.70 and reassess. Looking to the top side, 86, 60, 70, I believe, can contain the bulls in the short term. Well, that's a wrap. Thank you for joining me, and as always, look out for the intraday report. I hope you enjoy the great start to the new weekend.